Hello, Business 202. This Google Hangout gives some background information about the case problem assignments for chapters 21 through 24. Let's start with case problem 21.4, which is on activity-based costing. Here you have a company, Warwick Printing, and they are planning their labor for the upcoming year. And in the last year, you can see that they had 3 different types of banners. Now, these banners go through a coloring process. 180 of last year's banners had a single color. 240 of last year's banners had 2-color, and 380 of their banners had a 3-color process. And if we would add the total number of banners that this company produced last year, from 1-color, 2-color, and 3-color, it totaled 800 banners. In the coming year, they are anticipating a good year, and as a matter of fact, they have introduced a 4-color banner. They anticipate 212 1-color, 274 2-color, 616 3-color, and 698 4-color banners for a total of 1,800 banners. Now, here's the goal of the case. The manager or the owner of the business says, well, plan for additional, and because we are increasing the number of banners to 1,800 from 800, 1,000 banner increase over last year's base of 800, and that produces a 125% increase in the number of banners. And the owner's logic is that also should produce a 125% increase in direct labor costs. Well, what do you think about that? The key to this exercise is to identify the cost driver for labor. A cost driver represents the activity that increases the number of hours that labor works. So what you should decide based on how you understand this process is whether the banners represent a good cost driver for direct. There's something else that would create more time and complexity in the manufacturing process. Yours to describe what that additional activity would be, and then to calculate the increase in that activity to determine what the increase in labor would be. For this case, assume that labor costs per hour will stay the same. Okay, that should give you enough for 21.4. Let's take a look at 21.5. Case 21.5 is, again, trying to associate activities with increases in variable costs. We're shifting from banner making to a company called Northumberland. So that's like a North Face or an LL Bean type of company. Now, this particular company is a shipping company, and they have a warehouse and then ship out all of their goods to their customers. They are experiencing a decrease in the number of sales that they make from January down through August. And as you can see, though, although the sales volume in dollars is going down, the number of orders is increasing as the year progresses, because the amount per order as the year progresses goes down. So here's the issue that this case presents to you. The shipping department manager has discussed the financial situation with senior management, and senior management has responded by pointing out that sales volume has been dropping, so that the amount of work in the shipping department should also be dropping according to senior management. Thus, senior management told the shipping department manager that costs should also be decreasing. Now, if you were the shipping manager, how would you respond to senior management? Again, this case involves identifying the appropriate cost driver that would drive shipping costs up or cause it to decrease. Is it sales volume, the number of dollars of sales that the company makes, or would it be some other type of cost driver that would more reflect the actual costs that the company would experience? Okay, that's the tips for case 21.5. Let's move on to the next chapter, which is chapter 22. And chapter 22 is dealing with budgeting, the beginning of the year planning process that aligns the resources that the company has with its strategic goals so that it can get the people, the personnel, and the finances to carry out that strategic mission. Well, here's the deal here. The marketing director for Star Computer Company had the following discussion with the controller, who is the chief accountant for the business. And the marketing director says, it looks like I'm going to spend a little bit under budget for the month of July. And the controller says, well, shoot, that's good. You're under budget. And Megan is saying, well, you know, I have some slack in my budget this month in July, but I think next month we are going to have some extra expenses. And this expense is going to be for a big campaign that will launch in September, 2 months from now. So what Megan is saying is that, well, I'm going to prepay some of those costs for August in the month of July and charge the July budget for those costs that originally were planned to happen in August. As a matter of fact, those costs still will be incurred in August. What Megan is doing is just prepaying them in July when there is slack in her budget so that the August budget won't be overstated. That's the setup, and here is the question. The question is, how should the controller, Cam Morley, respond, to the marketing manager's request to expense the advance payments for convention-related costs that will happen in August and September in July's budget? As you think about this, think about the purpose of the budget. The budget is going to align material, resources, and financing to carry out the mission. Management uses the budget as a communications tool to direct activity for the business. What type of information would it give to senior management if some of the costs were prepaid just to meet the budget? Is that a good thing for management to know? Is it a bad thing for management? Or is it a bad thing for Cam Morley to do? Or is it irrelevant? Okay, that is the case that you have with the ethics and professional conduct for 22.1. And let's look at another budgeting issue in 22.2. This is dealing with the city of Milton. So we're shifting from a manufacturer that does a budget to a city that does a budget. And the city has a fiscal year that runs from July 1 through June 30th. And the city managers have charted the costs, the actual, compared to the budget amounts. And you can see the zero line represents no difference between actual and budgeted costs. But since this line for the budget minus or actual minus budget is below zero, that means actual expenses for the first 10 months of the year have been below what was planned. And then as May and June roll around, there is a real rush to spend the budget just to make sure that, well, if we don't spend it this year, we are not going to get the same level of budget next year. Okay, so interpreting the chart we just did. There is an end of the year rush to spend the remaining balance in the budget. Your job for number 2 or point 2 is to suggest an improvement in this particular budget system. A little bit of context. What is a budget supposed to do? It is supposed to help the entity attain its strategic goals. What kind of entity are we dealing with here? We are dealing with a city that is supposed to provide services to its citizens, like fire, like ambulance service, like street cleaning, like parking. So if the city is underspending, that means what about the services that it's delivering 10 months of the year? And then what happens in May and June when there is a big rush to spend the budget? What does that do to the citizens? And how should the city elected officials monitor the costs throughout the year? Okay, that's this particular case. Moving on to chapter 23 is a case on variances, 23.3. And you have been asked to investigate some cost problems in the assembly department of an electronics company. Now, think about the manufacturing that goes on in an electronics company. It's not heavy manufacturing. Think Apple, think Dell computers, think iPhones. So it's not like they're making buses or cars or heavy-duty excavation equipment. So this particular company has 3 different departments. It has an assembly department, it has a purchasing department, and it has a fabrication department. The purchasing department is the first department in the business that buys the raw materials. The fabrication department assembles the raw materials, integrated circuits and wiring and electronics type pieces into parts that the assembly department, the final department, puts together. Now, as you see in the assembly department, they have a whopping direct labor unfavorable variance. They were supposed to spend about $227,000. I'm sorry, they were supposed to spend $157,000. They have at their flexible budget amount $227,500. And so the direct labor use variance is unfavorable almost by 50%. For direct materials, same type of situation. The standard was just under $300,000. They actually spent $385,000, and so the amount of materials that were used in the assembly department was over budget by some 25%. Now, the reports from the other 2 departments indicate that in purchasing, the purchasing department actually spent $385,000 for the material that they bought, and the standard for that would have been $437,500. So the purchasing department got some good deals by paying $52,500 less than what was budgeted. Also, if we look at the fabrication department, the direct materials use had no variance at all. They used exactly the number of materials that they planned, and the fabricating department saved some money from budget in direct labor. The standard quantity at the standard rates, what it should have cost to produce the units that they did, was $245,000. The fabricating department only spent $203,000 for a $42,000 favorable budget. And now comes assembly. Assembly has a labor budget that's a whopping amount over standard, and a materials variance that is a whopping amount over standards. So right now, the assembly department manager has to explain why in the heck this kind of unfavorable variance is occurring when the previous 2 departments did very well and have favorable variance. So here are the comments between the investigator and the manager of the assembly department. And essentially, the assembly department manager says, well, all of this quarter, we have had to rework stuff. Uh, the stuff that they received from the assembly department has been shoddy, and the manager is hot and says maybe around 20% of the stuff that comes from fabricating just can't be put together. The fabrication is all wrong, and as a result, we've had to scrap and rework a lot of the stuff. And naturally, this has just shot our variances all to heck. Your job is to interpret what might have caused the assembly department to experience the type of rework and extra use of materials that it did. This is a theme that you have seen in other problems where cheap materials may not necessarily be the least expensive. Why? They may not be up to spec. Okay, what you want to do is to infer what has happened in the previous two departments to help the assembly department manager explain what might have happened in the department that he or she runs. And remember, the assembly department manager is saying about 20% of what is done is rework. Does that reconcile with the level of these unfavorable variances? All right, that's your tips on that case problem. Let's take a look at 23.4. This is for variance interpretation again. And here you have another audio company, again, electronics type work. And the plant manager has received a bad variance report. This is for overhead. The actual costs were $133,600, and what should have been incurred was $121,280, and we're tipped that the actual units produced was 15,000, which was 10% below the capacity that they had planned. So despite working less, the manager is being faced with large unfavorable variances that are about 10% off of the budget. So 10% less cost and 10% less output. Does that reconcile? Well, the plant manager obviously is not satisfied with this, and the justification is that, well, some of these costs are fixed. And so no matter whether the company produces a lot or a little, many of these fixed costs stay the same. So if the controller has buried some fixed costs in these supposed variable costs, that is the cause of these unfavorable variances. Based on your understanding of how to calculate variable overhead controllable variance and fixed overhead controllable variance, does that justification that comes from the overhead department make sense? In other words, put yourself in the shoes of the controller, and would you buy that justification that the unfavorable variances that you see in this overhead report are caused by fixed costs being mistakenly rolled up into this variable cost report? Okay, that takes care of chapter 23. Let's take a look at case problem 24.2, which is on evaluating divisional performance. This is a deal with transfer pricing, and transfer pricing is the price that intercompany sales are priced or valued at. In this case, we have a food company like a General Mills or a Yum Brands meaning that the manager in charge is responsible for revenues, costs, as well as the level of investments. Return on invested assets and residual income represent the two types of measures that are used to evaluate investment centers. Now, as you can see, the invested assets are shown for each of the divisions, and snack goods at $2 million of invested assets is the largest division. However, the cereal division, with the second largest or the lowest level of assets, has produced the highest level of income. So the question is, the division is making the best use of invested assets and should be given priority for future capital investments. Second question is, assuming that the minimum acceptable rate of return for this company is 19%, would all investments that produce a return in excess of 19% be accepted by the individual divisions? Okay, to think about this, put yourselves in the shoes of a division manager. Let's say the cereal division. What would the cereal division be? It would be $554,000 divided by $1.68 million. That is the standard that the cereal division had set forth. If it accepted a project that was only 19%, this is upwards of close to 30% here. If the division accepted a project that was less than 30%, it would bring its return on invested assets down or show a declining trend. Would that be something that the investment or the manager would invest in? Okay, that's the hint on question number 2. Question number 3, can you identify opportunities for improving the company's financial? Okay, the two things are being viewed: return on invested capital and residual income, also known as EVA. What is involved with this? Well, number 1 would be the level of income. How would the company increase income? And 2 would be the level of invested assets. How could the company improve the effectiveness in these assets in generating revenue? Those would be the questions that you would respond to for item number 3. And let's take a look at case problem 22.4. This is the third topic that you have in Chapter 24 on service department charges. Service department charges would be corporate overhead costs that would be incurred by the corporate headquarters and then allocated on some rational method to the various departments. And here, the corporate headquarters department is the customer service department of door industries. So they make garage doors and different types of doors for homes and other structures. And the service department asked the publications department to prepare a brochure for its training program. So the door industries is training new technicians to go out, install these doors, and satisfy customer repair needs. The publications department delivered the brochures and charged the customer service department a rate that was 25% higher than could be obtained from an outside printing company. So, in other words, the door industries division was being charged more by an internal division of its own company than it would incur if it would go to the outside. And why didn't it go to the outside then? Because upper management says you have to buy from the internal publications department, because the internal publications department had excess capacity that we just need to keep these workers busy. On top of that, the publications department claimed that the drop in the demand for its services caused it to have some, fixed costs to cover, and so they charged a premium so that they could cover their particular fixed costs. Okay, now think about this particular situation. One department, the door industries division, is being overcharged 25% over what it could get from the outside. So, how is that division manager going to feel about the corporate decision to buy internally? Secondly, you have the publications department that is being rewarded for not working and is able to cover lack overcharging its fellow division. Would that result in tensions between the different departments? Range of prices, could this publications department charge its services to the door industry? Okay, that gives you some background behind the cases for chapters 21 through 24. Please consider these items, do the write-ups, and upload your write-ups to Google Drive. Thank you, and ask questions as they come up.